Hi, this is Andy Hoffman, Media Director of Miles Franklin Precious Metals in our 25th year of business. It's midday, Thursday, June 19th, and the title of today's audio blog is The Rapidly Approaching Fed Waterloo. Clearly, my title refers to yesterday's flat-out embarrassment of an FOMC statement. Last April, the Bank of Japan decidedly lost its own battle with recession when it enacted the thus far catastrophic Abenomics money printing scheme. And as we predicted, the ECB had its own reckoning day 2 weeks ago, when Goldman Mario launched the hyperbolic money printing measures he had hoped to avoid via jawboning for the past 2 years. And now the Fed's own Jimmy Shaker Day approaches, when the printer of the world's reserve currency itself admits it's powerless to prevent the inevitable, but not only untapering, but reversing course and overtly accelerating its money printing. And for those that don't know what Jimmy Shaker Day refers to, I recommend you watch the awesome Mel Gibson movie from the 90s called Ransom, when the criminal character played by Gary Sinise vows to stalk Mel Gibson for all of time until he finally gets his man. Just as the inevitable global hyperinflation stalks Shinzo Abe, Mario Draghi, and whirlybird Janet Yellen. Now, heading into the report this week, we saw another $24 billion of net foreign sales of U.S. paper securities in the monthly tick report, including the third straight month of Chinese net sales of treasuries. Remember, back in November, the PBOC flat out said it is no longer in China's interest to accumulate foreign exchange reserves. And since just the amount of their surpluses would be enough to take out all of the world's gold supply in a year, it shows you just how much they need to get out of their dollars and yen and euro and into items of real value, and how there will be an unstoppable floor price in demand for gold and silver going forward, pretty much permanently until the whole system goes down or there's no gold left and silver. Wednesday, a 5% weekly plunge in new mortgage purchase applications and a 13% plunge in refinancing despite rates plunging to multi-year lows. And again, this is the essence of what's wrong with QE. The economy is falling apart. And if people won't buy houses with rates going down, mostly because they can't and because they've been priced out of the market by the 1% that's gotten all of the money and bid up all the properties, you can see why pushing on a string is too optimistic of a term for what the Fed is doing right now. Better yet, on Wednesday, the current account deficit exploded from 81 billion in the fourth quarter to 111 billion in the first quarter, way above the $99 billion expectation. So again, on all cylinders, things are going wrong when you look at real data. Heck, I didn't even throw in Tuesday, the CPI twice as high as expectations, yet housing starts and permits were way below expectations. So on all fronts, things are going wrong, except the Philly Fed Diffusion Index was higher today. Again, how many times can I talk about diffusion indices, which are completely meaningless, arbitrary, manipulated, and have no correlation with the economy? Then again, once you look at the Philly Fed components, you go, how about that? The biggest thing that went up was prices paid, while prices received went down. So the component that went up the most was actually a negative for the economy. That's how ridiculous these things are. And then you throw in the other chaos of what's going on in the Ukraine, where we're at full-out war right now. In Iraq, where not only are the Sunni ISIS rebels threatening to take over Baghdad, but now we're talking about full-out verbal wars with Saudi Arabia and Iraq, Iran getting involved. We may actually recruit Iran as allies, the very same people who hate us more than anyone in the world. So it's not a surprise that oil prices are at the highs of the year going into the summer driving season, just as the global economy is at its lows, and the Baltic Dry Index for that matter. Let's see here. Oh yeah, how about John Kerry now saying that he sees more evidence of Syrian chemical attacks? They're kind of mythical weapons of mass destruction type thing over there. So clearly we're trying to start a war with somebody. And whether we succeed or not, we're certainly going to drive oil prices high. And as we know, we're driving Russia and China to create these anti-dollar alliances as quickly as possible, which will only seal the fate of the petrodollar and the dollar's reserve currency status itself. Better yet, how about the U.S. Supreme Court actually making a ruling that Argentina is not allowed to pay off its debts until it pays off U.S. hedge funds first? And as a result, Argentina is about to default and probably go into hyperinflation, thanks to U.S. Supreme Court siding with U.S. hedge funds, who lobby just as aggressively as what we now call activist shareholders to the government as they do to companies themselves. That's how far this empire has crumbled. And then, of course, we have the FOMC statement yesterday, which my article, which is about to come out today, which is a must-read, discusses. It's called Yellen's Last Stand. And here's my quote from it. Frankly, the Fed's presentation was so defensive and uncoordinated, it felt like I was watching General Custer in his last hours at Little Bighorn. Make no mistake, the Fed is decidedly losing its propaganda war. And when it is shortly defeated, as Japan was last April, and the ECB 2 weeks ago, 3 years of historic precious metal suppression and recovery propaganda will be abruptly halted. In it, the Fed reduced its 2014 GDP growth estimate from 2.8 to 3% last quarter to 2.1 to 2.3%. Of course, they blame the weather, even though we've proven mathematically that the weather had nothing to do with it. Better yet, remember their initial estimate for 2014 was 3.3 to 4% growth. And thus, we've already had a 40% drop in their estimate for GDP growth for this year, and we're not even at mid-year. And remember, the end of the year is when the estimates typically go down even more, let alone if oil prices continue to go up, which will destroy everything. So that's part one of the Fed's lunacy. And again, I put some graphs in my chart today showing how every single year the economists, the Fed, the government predict too high, and then it goes down from there, the expectations. And look, I was a Wall Street analyst for 10 years. It's the same thing with analysts. David Stockman called it a hockey stick. We're always expecting things to get better in the future. And it's no different on Wall Street, who are incentivized, and Washington obviously, to tell you that things are getting better. In the case of the Fed, it's not just their credibility and, of course, their jobs on the line. It's the fate of the dollar itself and the credibility of the institution and Keynesian economics that are on the line. So, of course, they're going to be confident that things are going to get better. The problem is they never are any better. And if you look at what the Fed actually did in their, again, they tapered. They're going to go from $45 billion a month to $35 billion a month now. And I love how this tapering propaganda has gotten so ridiculous over the past year. People actually think tapering somehow equates with tightening policy. No, they will be overtly buying $35 billion a month of QE, of treasuries. And of course, as I wrote in Proof of the Tapering Mirage last December, they do much more than that if they need be. Heck, they recruit Belgium to do it if they need be. So the point is they're not tightening anything. And of course, they maintain, we're going to keep the zero interest rates ad infinitum. In fact, if you look at what the board voted, in the last meeting, 13 governors said they expected the first Fed rate increase in 2015 and 2 in 2016. Well, now it's 12 in 2015 and 3 in 2016. So the net change of this meeting, in which John Hilsenrath of the Wall Street Journal says they are getting more aggressive, is that one of the governors actually said, you know what, 2015 is too soon to go up from 0%. I got to make it 2016. And then the big comedy is they say, well, we expect on average that the Fed funds rate at the end of 2015, meaning 18 months from now, will be 1.1%. 1.1%. And that compares to the 60-year average of 5.2%, which with, 10 zillion, quadrillion, billion dollars of debt can never even come close to being approached, because the whole world would fall apart. Heck, half of that, the whole world would fall apart. So, you hear that and you go, I mean, do you really think that that ZERP is ever going away? And heck, maybe we'll have NERP soon, just like Europe does. And of course, the coup de grace is going to be when Janet turns around and says, "Yep, doesn't work. The QE, the tapering policy is not working. It's time to turn it back around and ramp up the printing presses," which already they're doing covertly, but soon they'll be doing overtly. Of course, those weren't even what I call the day's best stupidity highlights. For one, you had John Hilsenrath saying that the Fed was more aggressive in this statement than in previous statements, which is absolute ridiculousness. But better yet, Janet Yellen said that the recent increases in food and energy prices, particularly food, which is certainly not going up for any one-time reason on a worldwide basis, is just noise, so don't worry about it. And when she was asked, do you think is a bubble forming in stocks given that you're seeing record stock prices while you're also seeing record bond prices? No, nothing to see here. So they got everything under control. No worries about that. Meanwhile, as I wrote, and I always write about, the Fed manages the markets just before these statements so they can have maximum cushion to state whatever they want. There was this mysterious surge in the Treasury bond yield the day before the Fed meeting from the 2.6% line in the sand I've been writing about forever. 2.6% and upset is the article, meaning the Fed is afraid of what I call the most damning proof yet of QE failure. That would be plunging interest rates despite all the money printing. And 2.6% on the 10-year yield is what they've been protecting because it's a long-term support level. So, naturally the rate magically just jumped up right before they made this dovish statement. And sure enough, today, plunging again 2.57% because the whole world knows that they're getting ready for Yellen's last stand. This is Yellen's last stand because eventually her Jimmy Shaker day, like Draghi's reckoning day, is coming soon. And frankly, I would be shocked if it's not in the next 12 months, let alone the next 6 months. As for the markets, here we are a day later, 2.57% on the 10-year yield. And we'll look at this. Gold is up $24. How about that? Exactly 2.0%, which is the cartel's upside limit on 99% of the time. Of course, that limit will be gone by the wayside, just like it did when the London gold pool was destroyed. It's coming soon, probably sooner than you think. And I see silver's up 50 cents. It's blown through what I call battlefield $20 silver. And it's going to be pretty darn hard for the powers that be to hold things down. And I'm not going to put too much into single day's action, but when I see someone put in a $500 million gold futures order just before the COMEX open, always makes you wonder if someone knows something. I guess we'll see soon, but the point is gold and silver trading well below the cost of production. Record physical demand worldwide. Plunging supply, plunging investor optimism, certainly in the Western Hemisphere, and of course, Yellen's reckoning day or Jimmy Shaker day coming on the horizon. Because when that happens, it's all over for the powers that be's ability to propagandize about recovery. It's going to be all about money printing and trying to stave off hyperinflation at that point. Okay, well, that's enough for today. Again, hopefully you're starting to realize the reality of the world is far different from what the money printing, market manipulation, and propaganda schemes are trying to tell you. The chinks in the armor are showing everywhere and getting larger all the time, and it's only a matter of time before this fiat Ponzi scheme, like all others before it, collapses. That's why you need to consider protecting your net worth now while there's still a chance. And if you do, we hope you'll call Miles Franklin at 800-822-8080 and give us a chance to earn your business. And as always, you can contact me with any questions you might have at ahoffman@milesfranklin.com. Thanks and have a good weekend.